Now, where I'm going with this is this whole sort of debate about technical and the fundamental landscape, and what should you focus on? Where is the opportunities, etc., etc. Now, I want to kind of dispel anything that you might have read or heard anyway, and I'm going to pose the question to you rather than say one is better than the other. I'm going to pose it in terms of where can you develop an edge. Okay, if you told me you've got an Excel model that is able to tell you the exact, fair value pricing of the S&P 500 equity index, and the moment interest rates shift, or whatever it might be, and you can tell me the exact fair price of it, I would say, well, fair enough. Then your approach and your strategy is very much geared towards a fundamental type approach, and you've got some form of an effective edge there. Okay, in that sense, you are more of a fundamentally driven type trader. However, and this is the crux of it, okay, the most of the people listening to this, if not all of us, okay, are some form of a retail trade. In other words, we don't have access to these models. We don't have access to, information flow, at the speed of light. We just simply don't have, the kind of fundamental information at our disposal to be able to develop a consistent edge. Now, don't get me wrong. You can develop some forms of fundamental edge. For example, the Axia traders are fantastically good at central banks. Okay, the reason is that every trade I've known since I started trading in 2011, we've been watching ECB and Feds and BOJs and RBAs. We've been watching this since for the last 8, 9, 10 years. So we know all the nuances. We know the members. We know what's expected. We know what's priced. We know what all the consensus is. So we know these things. Therefore, we have developed some form of an edge that we can call fundamental. Okay, so that's important to, just to interpret. Where does your edge ultimately lie? Are you capable of developing a fundamental edge? And if you can be truthful to yourself, I hear so many traders sending me a message saying, oh, do you think this is a sell because, for example, there's a big thing going around now this weekend, this past weekend, all about because the Fed is now starting quantitative easing 5, in other words, with all the repurchase agreements they're doing and pumping money into the system and liquidity, in essence now the Bloomberg's come out with this big article that, this is effectively the start of QE5. And I had someone ask me, do I think gold is a sell because of QE5? And I said to him, well, look, if you go back in history and you look at QE4, obviously a quantitative easing is particularly a very strong sell for gold, and as a result, if yes, there was a quantitative easing 5, gold should sell off. But by no means does that mean we've started quantitative easing 5. Okay, by no means do we know the inner workings of what's actually going to be happening at the Fed. Okay, we just don't have the access to that kind of information. So rather than trying to bluff yourself, when you read the newspaper and you think this is a buy or a sell, just remember who you're up against in terms of the fundamental landscape. You're up against, companies that are spending billions and billions investing in algorithms that follow certain words on Google, and you're up against a guy that's trading off of inside information. So just remember who you're up against when you go the route of being a fundamental type trader. But like I said, you can develop very nuanced edges. Okay, now the same goes for the technical type landscape, all right? And this is where you see most retail traders being able to develop an edge. The moment you can step away and say, hang on a sec, clearly I don't have access to fundamental information. Clearly the fundamental information is too slow. I don't really actually understand what's going on. Therefore, I won't trade off fundamentals, but I will solely trade off technicals. Then you can develop a technical edge. Okay, and this is where I would always lean most young, particularly young, and retail traders, I'd lean them to go towards, because this is where you can still develop consistency and edge. Okay, and we're going to talk about one of those technical plays today. But before I go to that, I just want to talk about technical anomalies, okay? Because we've got one now in the gold, and this is very much going to be a gold-focused type stream, simply because the gold has kind of shown something very specific, not just all year. I mean, obviously gold is up sort of 17, 18% this year. It is the best, one of the best performing asset classes, or if not the best performing asset class this year. And then we're going to go through technical flags. Now, to get to that point, what I want to do is I kind of want to just explain what we mean by an anomaly, okay? A pricing anomaly. An anomaly is just it's just when something is occurring that is unusual, okay? You can think of divergences as an anomaly. You can think of, bad highs and bad lows in the market as an anomaly. You can think of, when fundamental news comes out and the price goes the opposite way as an anomaly. Okay, these are all anomalies that should correct at some point in the future. Okay. Now, very interesting. The reason I showed you this headline is because it's created somewhat of a technical anomaly in the gold market. Okay, what do I mean by that? To show you this, I'm going to get a chart up. All right. What you've got in front of you is the daily gold. I'm just going to make it nice and big. And obviously, we all know the technical landscape of gold, super bullish. Right? But what I want to lean on is the fact that on Friday we had this comment, gold was pretty much an failed inside day. In other words, we tried to take out the high in the morning and pretty much just could not hold prices above that high. Suddenly the comment came out and the market rallied from 15.12s all the way up to 15.23. So a good $10, $11 rally. But now hopefully some of you have picked up what that anomaly is. What is sticking out like an absolute sore thumb at the moment? Okay. Have a look on the bottom here. What do we see the volume having done on the bottom here? Okay, we can see a significant drop off in the volume over the course of the last 2 days. In other words, there's a real lack of trade being facilitated. Okay, that's all volume is. It's showing how much trade is being facilitated at these prices. In other words, there's no interest. Okay, there's no interest to be trading at these current prices. Right? Now, when you go through the technical landscape of gold in a minute, and I speak about this flag, I'm going to show you why this is a technical anomaly. Okay, when you have very strong, sort of bid-up price responses, okay, off of something like low volume. In other words, a very trending like close. In other words, we open at the low, close at the high, broken inside day to the upside. When we have these kinds of things, but volume isn't necessarily confirming, or the price reaction isn't necessarily confirming, we need to be aware of those anomalies. Okay, because at some point, not Monday, not Tuesday necessarily, could be, right? But at some point that anomaly is going to correct itself. Okay, now where I want to go with the stream is I want to talk a little bit about the gold market and what you can kind of expect to see in the next couple of days. Okay, and I also want to really drive home the technical concept of a flag, because again, and please, I say this with the greatest of respect, a lot of young traders are very fooled into thinking, we call this thing a flag, okay, and suddenly everyone goes, oh great, I know what to do with a flag, I buy through the highs and it goes forever, or I sell and I just make lots of easy money. It's not that straightforward. Okay, what you need to recognize is that chart patterns like a pennant, like a flag, chart candles like a doji, like a full-bodied engulfing, these are merely just events. They're just forms of price response. Okay, they do not imply any kind of statistical significance. And the reason is very simple. Think about this logically for a moment. There's what kind of, maybe if there's one little tidbit you can take away. If, for example, we had something like inside day breaks and the game player was just to buy through the break of it, do you not think that there are billion-dollar funds out there that have already stress-tested, probability-tested that strategy 1,000,000 trillion times over? Of course they are. Okay, and that's the crux of it. You've got to think as a trader. And this is what I'm going to show you now. I'm going to show you in a minute how you can learn to develop real intuition in understanding this concept that you're seeing that we call a flag. In other words, I'm going to show you what you need to be seeing when finally this flag is going to break out and we're going to have some form of breakout. Okay, so as you can see, we've got the flag. Okay, for those of you aware, we've got a nice little shoulder line here, nice little double top headline, and another potential right shoulder forming. Okay, the basic premise of it is obviously we can go back to all-time highs and then break through, but should we start to break down below that neckline, as they call it, we should then see prices start to drift lower. That's the basic premise. That's what they teach in the textbooks, and that's how we come to understand these things. Now, I'm going to throw a little spanner in the works. I'm actually going to explain to you what's happening. Okay, what you're seeing here is a daily footprint chart. Now, the reason you must learn about footprints is because it's going to explain the price reaction to you very, very clearly. In other words, it's going to tell you what's happening inside of this consolidation zone. Okay, a lot of people call this a flag or a pennant or whatever you want, For me, it's nothing more than a consolidation zone. I'm going to show you what's happening inside this consolidation zone. Okay, so to do that, we put the footprint on the daily. So these are all daily rotations. Okay? You can see the open and close on the left of the rotation. You can see the volume, the delta on the day. Okay, now what I want to show you is what's happened at the low and what's happened at the high of this range. Okay, so to start off with, I'm just going to put in the high of the range there. And let's go back. So, markets came bid, and we obviously had a nice bid up on this day. And you can see a very strong rejection. In other words, we traded higher, but we traded lower as well. So a very significant day. There's a good $60, $70 range. But in essence, right, the market very swiftly rejected the 1488s as well as the 1545. So there was swift rejection on both sides. And we can see that simply because of the time frame in which it rejected and where it closed. Right? Now what sticks out like a sore thumb? Note the blue line. That's just simply a daily average volume 10-day. We can see a significant amount of volume on this day. So there was very strong interaction on the buy side at 1488, on the sell side at 1545. Right. Obviously the volume now, because of that prior volatility, that volatility sustained itself for 1 or 2 sessions. Right? And we can see that there was no real price response. Okay, the market tried to move higher and started to drift lower. But what did the volume do? Okay, just completely dropped off. In other words, there was no interest to be facilitating trade or initiating trade within the zone of 88s up to 45s. Okay, and we can see that for a good number of days. It was almost an entire week. We see the volume dropping off, no real interest to trade in this zone. Right? All of a sudden, the market has a very strong update, double the volume. Okay, market comes back up towards that previous high. And the next day, we shoot higher again. In other words, there's a big stop run. Markets move from the 1535s all the way up to 65. So a really strong bid up. But what do we see? A very swift rejection. Okay? And that's important because now what we've seen is we've seen a strong rejection at 45 and then a strong rejection at 65. Right? In other words, we are seeing sellers be aggressive at higher prices. Okay? Notice what happens to volume again. Drops off, no interest to trade. And suddenly the sellers then enter the fray. Volume picks up. Okay, so now once we've seen sellers enter at 45s, we've then seen it at 65s, we've then seen it at 60s. Okay, market comes up again. Notice the volume. Nice big volume again. Market comes up again and tests that area of 65s again for a 4th time. And what do we see? Right, a relatively okay close, but the very next day, notice the volume substantial. Very swift rejection. Right. Can you start to see the picture I'm painting? In other words, every single time we trade in the zone 45s to 65s, there is very aggressive sellers just waiting to pounce. And they're not holding back. They're hitting the market pretty aggressively. Okay, we know that just simply because of the swift rejection. We can see $25 move. This day was a $45 move. Okay, now what I'm not saying to you is that you should have been selling and then cleaning up and selling and then cleaning up. That's not the purpose of this. The purpose is for me to explain to you how a flag or a pennant or a sideways distribution is formed. Okay, very clearly we got very strong sell side response at 1545 to 65. In other words, the only thing that's going to get us to start trending and rallying again is some form of a strong buy side response. In other words, buyers need to get a grip. They need to be willing to facilitate trade, not just around the 65 area, but above it. In other words, they've got to be willing to get above it and hold above it. If they can do that, then higher prices will come as a result. If they can't do that, then we're going to likely drift where? Towards the bottom end of the range. Now, let's go look at that bottom end of the range. So we came down to the 1488s. Right? Note this is the second test. What do we see? Markets sell off. Okay. Notice the change in volume though. Okay, on the highs, every time we got to these highs, 400,000, 500,000, 400,000, 580,000. What do we see on the lows here? 380, 290, okay, 470, 350. In other words, there's significantly more volume transacting at the highs relative to the lows. So what are we leaning on here? Okay, this is not a hard, fast rule, but what we're leaning on is sellers are very aggressively hitting into bids once we get to those high prices. In other words, they're very aggressive up at the top. But when we get to these lows, right, we're not seeing the same sort of aggressive buying coming in. In other words, what we're seeing is buyers are there and they're being hit, okay, but it's not the same aggression as we're seeing off of the top. Okay, it's still support, all right, because buyers are not willing to relinquish those prices yet. But the significance in the selling at the top versus the significance of the buying at the bottom is different. Okay, they're not the same thing, and that's how you interpret this. So again, we saw it come down on Wednesday this week. Look at the volume, 340. Okay, significantly lower volumes than we're seeing at the top. Now, the same thing at the top. If we want to see any form of sell side continuation to the downside and actually break this 1488 and sustain the the short-term trend to the downside, we're going to need to see those volumes pick up. And we're going to need to see those sellers start facilitating and initiating through 1488. We get that, prices will continue to sell off. Until then, it's very simple, guys. We're going to keep trading inside this range. Okay, the volumes are going to be very low in between this range, and we're going to see a lot of low volume up days like we saw on Friday. Okay, so going forward, just be very, very aware of this technical anomaly. It's very likely that come Monday, we should retrace at least a large portion of this late move back down to the 1512s. But like I said, it's difficult to pick simply because of where we are located. Okay, we're stuck in this $80 range. Right? So until the point that we see acceptance below 88 or acceptance above 65s, we're stuck in a range. Alright, I hope that really explains the concept of a flag to you. Now, the reason I came about this, and this is pretty much where we're going to end the stream, is I had this question come to me. Do you think gold is a good sell given it has gone very far?